Hi, so you've got a killer trading strategy that works perfectly with $10,000. And then you scale to 100,000 and it still works pretty well, low returns, but still good enough. But then you want to scale to a million and your returns evaporate. So why does that happen? And that's what we're going to cover today. And I'll give you a quick 5-minute formula that you can use to evaluate this before this happens. And the question is basically, why do most traders fail at scaling? Why do most funds struggle with scaling? And one of the central things, the central problems with this is market impact. Because, no matter how small the trade is, every single trade moves the market against you. With small trades, you also move the market against you only a tiny bit, so then it doesn't really make that much of a difference. But the more the basically the bigger the trade size is, and I'll show you a very good formula for this, the more market impact you're going to have, and the more you're going to move markets against you, and the less of a return you have. So there are basically two types of price impact. First, you have market impact, which is basically a temporary impact on the price, probably only a few seconds or something, or minutes, depending on the size, of course. And then, of course, the more long-term one is something relating to the fundamentals, something relating to macro trends, things like that. But now we're going to focus on the short-term one because that's what's eating your profits. So you calculate market impact with this formula, and I'll show it on the screen here somewhere. Basically, market impact is equal to a certain factor or a coefficient, and this is different for every market. So either calculate it yourself or look it up. For Forex, it's usually lower, in the lower single digits, so to speak. So 0.1, 0.3, something like that. Large cap equities, more like 0.5. And then, for example, altcoins, stuff like that is more higher. It's like higher than 1, probably 1.5, something like that. And you multiply that by the daily volatility and multiply that again by the square root of your trade size, basically your order size, divided, still in the square root, divided by the daily volume. And this gives you a very good calculation for the market impact. Okay, and now you've plugged in all your numbers, you've calculated it, you now have a number. What does this even mean? So it's a decimal number representing a percentage. So if you just multiply this by 100, you have a percentage. So for example, if you get something like 0.001 multiplied by 100, that's 0.1. So you have 0.1%. So that means basically if you had a result like 0.1 or 0.001 times 100, 0.1%, that means you move the market by 0.1% were you to execute this trade. So this lets you very easily calculate how much you move the market against you, depending on the order size. And this, of course, makes it quite easy for you to adjust the position and order size to minimize market impact. So rules of thumbs for this, basically the more volatility you have in a market, the more volatile a market is, the more you also move it against you when you do trading, and the less daily trading volume there is, also the more you will move it against you. So what you want is to minimize market impact and thus maximize your returns, is to minimize or have a market with very low volatility but high volume, ideally. And here's a very good idea for you. So how about you just build this into your position sizing? Because of course this formula is quite simple, so it doesn't take a lot of compute, of course. So you can just on the fly, if you have all of these numbers, of course, and then the intended order size, you can just on the fly calculate how much market impact you're likely going to cause. And then you set yourself a limit. And you can, of course, test this out in real conditions, in real life, depending on which limit you set, how much return you still get. And basically on the go, adjust your order size, maybe even try out a few different numbers in terms of the size of the order, and look at which market impact is still tolerable to you, and basically to maximize position size, to maximize profit, but minimize market impact. And what you can also do is use this as another metric to evaluate a strategy before going live. You have your Sortino ratio, your Sharpe ratio, your max drawdown return, of course. But this is another very nice metric to use before even going live, before you have this phenomenon where you scale and then you hit your roof, your limit, because you move the market against you. Evaluate your strategies with this before going live. And another big thing is that depending on how high frequency you trade, if you do basically very long term or like longer term trading, I guess also in that case more manual, then think about how to split up your intended order over multiple orders, and how much time between them, so to make the market regenerate, so to speak, in order to still get your intended effect. And in my opinion, what's also crucial is not just diversification in terms of assets, also to spread out basically your assets under management to have less market impact and thus higher returns, but also diversification across strategies. So that basically means that you have strategies that work differently, and under the same conditions, market conditions, they will not give you the same signals. So even if you, for example, trade multiple strategies on the same market, you're not going to have entry signals or exit signals at the same time of all different strategies, because they exploit different edges. So in my opinion, it's not just very crucial to have asset diversification, but also strategy diversification. Okay, and that was it for today. Try this out at home. And I really think this is a very good formula and calculation to try. So let me know in the comments down below what your results are. I hope this was helpful to you. Hit the like button, okay, and smash the subscribe button and the bell. And thank you so much for watching.